Welcome, everyone. Thank you for joining the first quarter 2026 Zevenbergen Capital Portfolio Manager Insights webinar. My name is Tina Boggs, and I'm a client relationship manager here at Zevenbergen. And I'm joined today by principals and portfolio managers Joe Dennison and Anthony Zachary. Joe, Anthony, thank you both for being here.
Thanks for having us.
Together, we'll cover how ZCI is navigating both the current market environment and how we're positioning our client portfolios for long-term results. As always, if there is anything we discuss that you'd like to explore further, don't hesitate to reach out. Our team is always happy to connect and serve as a resource. Joe, Anthony, welcome.
Yeah, thanks for having us.
So it's fair to say that it's been quite a volatile quarter. And one of the things contributing to investor unease has been artificial intelligence and what that innovation means, not only for our daily lives, but for how we work and the economy in general. Anthony, you've followed the tech sector closely for quite some time. How have our thoughts on AI evolved since that initial wave of excitement around the debut of ChatGPT back in 2022?
Yeah, and you can't go a day without some AI-related headline or product announcement. Just like in 2022 through to today, we continue to believe that AI is a transformational tool and a platform for invention. And what we've learned over the past 3 years is that AI is much bigger than text generators like ChatGPT. AI includes vision and sensory models that power autonomous vehicles and robotics. AI includes recommendation engines that provide hyper-personalized web experiences. AI also includes systems that decode weather patterns and help us understand the secrets of the human body. Over time, we believe that the automation of intelligence will have wide-ranging impacts, some obvious, others not so much. If anything, we have been surprised by how quickly the narrative around these tools has gone from fun, novelty, or an eager but clueless intern to business strategic imperative. And that's a remarkable change in tone and energy with a straightforward reason. The technology has gotten cheaper, it's gotten better, and it has enticed more people to tinker with it, to test it, and to implement it and deploy it into their everyday lives. And we think that trend continues from here.
So how are we reflecting those beliefs about AI into how we are positioning our strategies today?
One simple framework we've used in how we categorize AI investment opportunities is that there will be companies that build AI, there will be companies that use AI, and then there will be companies that will be disrupted AI. We want to own the builders and the beneficiaries. At this point, the builders are easier to spot. AI demands a significant amount of computing, storage, networking, and power resources to make the software come to life. And the picks and shovels providers, companies like NVIDIA and AMD, those that are fueling this gold rush, continue to benefit from the hundreds of billions of dollars spent on this infrastructure. The ultimate beneficiaries of the technology, I think, will play out over time. There have been some green shoots of development and deployment, but overall, we have yet to see that killer use case or that killer use of AI. And the disruption story is a little more complicated. We do believe that AI will speed up innovation engines at legacy businesses or in non-IT industries. Yet, we think it will have implications on competitive advantages, on pricing power that investors continue to wrestle with. We do believe that the market could be underpricing the value of domain expertise, hard to replicate data, as well as distribution channels, that get technology into the hands of end users, individuals and businesses. Much of this, that legacy software companies have already established. And let's not overlook, the fact that ripping and replacing a supply chain system, a payroll system, a payment system, that's no trivial thing. And especially with less proven technology, such as agentic systems, and especially if these companies do not have the internal resources and talent base to actually do it. So yes, AI is important. It's playing throughout the portfolio, and we still believe that the majority of economic value capture will be from or within the ultimate users of the technology.
And in addition to AI, another major source of investor uncertainty has been what's dubbed Operation Epic Fury. Joe, how has the conflict in the Middle East impacted our decision-making across the portfolio?
Yeah, when we look at the Middle East and how tensions have rippled through to US equities, it really comes down to three interconnected forces, that being inflation, central bank policy, and uncertainty. On inflation, obviously the primary concern is energy. Sustained regional friction threatens to reignite inflation and acts as a tax on everyday consumers and corporate profits. Because of these lingering price pressures, the Federal Reserve has also been forced to hold interest rates steady for longer than we in Wall Street had initially hoped. And now expectations for additional rate cuts this year continue to trend downward. Overall, the result is just more uncertainty. Markets hate the unknown, and geopolitics fuel that short-term volatility and downward pressure on broad markets, and especially longer duration risk assets like the growth stocks where we are invested in. Our job, as always, is to separate those headlines from the noise and the fundamentals that are actually happening. History shows that regional conflicts can cause these knee-jerk pullbacks, but they rarely derail long-term bull markets. So we're using this volatility as an opportunity, further adding to positions where we have the most conviction. Companies that offer differentiated, highly necessary products or services with strong pricing power in the consumer and technology spaces are very interesting for us right now. As our new innovative healthcare companies that can offer demand that's decoupled from the economic cycle, it allows us to play both defense and offense as they layer on new product cycles. The change, as we always say, is an opportunity and an opportunity for us to do the work, dive in and understand what's temporary and what's structural. Always stay disciplined and aware of the environment, but always focused on the long term.
So if we do take a deeper look into our portfolios, how did AI and the conflict with Iran influence our contributors this quarter?
I'll get us started. At least with AI-related capital expenditure, among the major cloud computing and internet companies, it continues to be strong, with indications that it will remain stronger for longer. And that dynamic has rewarded the building block companies that we own and across our strategies. Vertiv is one standout. This company sells critical power and cooling equipment used in data centers to keep server systems operating efficiently. In the most recent quarter, the company doubled its backlog to $15 billion, with management indicating 2026 should be another year of fast growth. Another company related to this data center power theme, but playing it from a different angle, is Quanta Services. They are an electrical contractor helping develop and refresh infrastructure for utility companies, telecom companies, as well as energy companies. Management foresees accelerating demand for electricity, as utilities invest in generation and transmission capacity to better handle AI energy demands. On the defense side, I'll talk about Karman. Karman is a manufacturer and distributor of critical components and subsystems used by defense contractors and space companies. Shares responded to positive fundamental execution and invigorated appetite and investor interest in aerospace and defense, as a theme for growth. we see robust demand trends persisting for the next 3 to 5 years for Carmen.
So obviously, sort of another byproduct of these unanswered questions about AI and the turmoil in the Middle East has been a rattled consumer. Joe, you spend a lot of time on the consumer discretionary segment. What are you seeing in terms of spending trends and consumer sentiment, and where are you seeing pressure at the company level?
Yeah, I'd say once again, uncertainty is the key word here. Spending has been not only positive, but the noise and inflation and declining sentiment have certainly led to more deal hunting and narrowing trends in travel and truly discretionary purchases. Three of the largest detractors for us for the quarter were consumer-related stocks, but I would say the stock declines were largely for reasons outside of just plain consumer weakness. So starting with Shopify, headwinds have been more on broader software concerns rather than pure consumer weakness. As AI and potentially agentic shopping become more mainstream, the market's been concerned about where Shopify's role might be in that evolving ecosystem. Fundamentals, on the other hand, have been very strong. The company had 30% year-over-year top-line growth, and their early evidence suggests that the investments and partnerships that they're making in AI are paying off and positioning the company as a truly mission-critical solution for retailers worldwide. Next one in the consumer section is Mercado Libre. Once again, fundamentals have been phenomenal. Quarterly reported revenues were up 45% year over year. Concerns from the market on Mercado Libre are mostly on competition and the investments that they're making. So they are leaning into their strength by investing more in free shipping and expanding their credit offerings. But in an uncertain environment, markets would rather them prioritize short-term margin protection rather than long-term value creation. Our history investing not just in Mercado Libre, but in e-commerce in general have shown that these investment cycles come and go, but the long-term moats that the company is expanding are really difficult for others to replicate. And then finally, Tesla, after a very strong pull forward in demand ahead of last year's electric vehicle credit expiration, top line sales were more mixed, but the company did see continued strength in its energy business, and free cash flow came in well ahead of expectations. Once again, the investments that the business is making were a concern for impatient markets, as Tesla's CapEx guidance came in ahead of expectations. But a catalyst-rich year is unfolding in front of us, which includes the expansion of full self-driving and robotaxi markets, launch of the Cybercab and Semi, and further progress on its Optimus robotics program.
And Joe, I imagine that with that market volatility, we're seeing some high-quality names that are trading well off of their highs and historic valuation ranges. So tell me, how are we distinguishing between temporary dislocations and situations where the investment thesis may be changing more fundamentally?
Yeah, I'd say the first thing is that drawdowns are normal for the kinds of businesses we own. A study was done on the top 20 best performing stocks for the 40 years between 1985 and 2024 and showed that every single one of those outperformers had a drawdown of at least 55%. With the median drawdown coming in at just over 70%. So when we see volatility in markets, the instinct shouldn't be to panic. It's to really go back to those first principles and fundamentals of the business. Ask questions like, is the addressable market changing? Has competitive moat eroded? Is the management team still in place and still executing on the roadmap that we originally underwrote? If all those answers are still yes, then a 20 or 30 or 40% drawdown driven by macro volatility, margin investment cycle, or sentiment, it's not a broken thesis, but really an opportunity. So just a reminder that volatility is normal and the price that investors pay for long-term outperformance. I'd say where we get more cautious is when the core business is deteriorating. We see excessive management turnover or the original investment thesis starts to drift. If we go back to Mercado Libre, Shopify, and Tesla, these are companies who are currently being punished in part for investing aggressively ahead of massive opportunities. They're putting the resources behind products and platforms where the world is moving and really positioning themselves for strength in the decades to come. These are also management teams where we've built a lot of trust and conviction over the years. They continue to have to prove out that trust, but a history of strong execution and founder involvement have historically been among the most reliable indicators for us for future long-term success.
And then maybe from a research perspective, what's captured our attention this quarter? Are there any areas where our conviction has increased? What are some of the notable highlights that we'd like to share with our investors?
Yeah, lots of activity happening outside of the geopolitical environment that's dominating headlines. We continue to see capital markets sustain their momentum. We talked last quarter about the announced acquisition of longtime portfolio holding Exact Sciences by Abbott. So happy to see that deal completed earlier than expected and delivering a great value for us and other long-term shareholders. The rise of agentic AI and how individuals and enterprises are moving from testing to implementation is truly impossible to ignore. Anthropic's Claude has made massive waves in the enterprise segment and caused some shocks to the market. But the reality is these tools are truly game-changing and evolving much faster than many anticipated. These periods of change present opportunities, and excited to continue to dig into, as Anthony mentioned, where that ultimate value will accrue. And then finally, towards the end of the quarter, we saw Tesla announce a $25 billion joint venture with SpaceX, targeting chip fabrication in Austin, Texas. This joint venture sits at the intersection of the largest megatrends in the world today: the reindustrialization of America, artificial intelligence, robotics, and the space economy. Just over a year ago, the idea of flying data centers in space seemed laughable. And now here we are seeing real progress and investments being made by companies with a history of innovation, vertical integration, in manufacturing. Well, it's an exciting time to be a growth investor. Innovation's high, and cautiously optimistic for the continued opening of the IPO window, but also still think there's a lot of underappreciated opportunities already in the public markets.
And as long-term investors, we are always looking ahead. Anthony, where are you currently finding growth opportunities that you think are either misunderstood or maybe unappreciated by the market?
As fundamental growth investors, we go wherever the best growth ideas are, and including places that aren't stereotypically known for growth investment. Our forward-looking approach thrives, as I believe, in periods of significant change, whether that's behavioral, regulatory, geopolitical, and technological. AI is an obvious example of a significant change agent that we are doing a lot of work on. And sometimes the real question is not whether a product, a service, or even a business or business model will have an impact on our daily lives or how we do work. It's by how much, it's the degree, of impact, or for how long. It's the duration of impact. And we, over the past 40 years or so, we've always found opportunity, where there is excessive skepticism and conservatism about a new way of doing things. And so that's where, in general, we are looking for underappreciated and misunderstood opportunities. And partly why we've been doing more work in the industrials area, as an example. This is an area that many growth, especially aggressive growth investors, do not look, or they regularly, overlook. And we believe that's a mistake. From space as the next frontier to American dynamism, these themes we believe are durable, if not inflecting, and they could provide significant growth opportunity, for public equity investors, over the next decade. We do believe that the SpaceX IPO, which is speculated for this year, could attract more investor attention on the aerospace and defense sectors, industrials more broadly, and validate what we're seeing in the market.
And despite recent volatility, why is it a good time to be a long-term growth investor?
Right. And despite this elevated uncertainty and angst with regards to AI and the conflict in the Middle East, we believe there are several reasons to be positive on risk assets in general and then growth equities. The first, we have fiscal stimulus in the first half of this year. The second is we could experience interest rate relief in the second half of this year, which could spur capital investment activity, home purchases, auto loans, and so forth. We do believe that we will see more AI proof points, quelling some angst about the return on investment or the spending levels in the ecosystem. We could experience a pro-cyclical environment, which could broaden market participation, which should quell, some of the concerns about market concentration levels. And on a more tactical, basis, equity valuations and growth stock, valuations have reset lower year to date. So that provides a more attractive entry point for investors. And then looking at growth stocks specifically, the gap between growth stock valuations and value stock valuations, has reached the narrowest level in the past 3 years. Again, another attractive entry point for growth stocks. Now, stepping back and thinking about Zevenbergen Capital and what we are, offering, our conviction, in the power of fundamental execution on long-term investment outcomes has not wavered. Our strategies feature companies that have the potential of compelling returns and significant wealth creation over the years to come. And as important as what we own is what we do not own. And we believe that there are business models and companies, that will be on the downside of the change that we've talked about, on this call. And we believe it's worth staying selective, in growth, in technology, in industrials, and elsewhere in the market. So we are very positive and confident, that our approach will bear out over time.
Great. Thank you so much. Joe and Anthony, I want to thank you very much for your insights and your expertise today. I want to thank everyone on the call for their interest and their partnership with Zevenbergen. And as always, we're here to answer any questions that you might have. If you want to follow up on any of the topics that we talked about today, please feel free to reach out. Thank you again.